Imagine a company once worth a staggering $22 billion, now literally fighting for its life in courtrooms from New Delhi all the way to Delaware. This is the story of BYJU'S, an edtech giant staring down a winter of impossible choices, where the next 180 days, well, they're going to decide everything. Let's get into how it all came to this. So we're going to break this story down into 5 parts. First, the courtroom countdown. Then, how the company went from a single teacher to an absolute titan. Third, how that billion-dollar bet started to unravel. Fourth, the 180-day crossroads they're at right now. And finally, we'll get to your call and the big takeaways. You know, this quote from the founder, Baiju Ravindran, it really captures the core conflict here, doesn't it? He built his entire identity as a teacher. But even as he was saying this, his company was getting tangled up in legal battles that threatened its very existence, a world away from any classroom. And the pressure is just immense. I mean, it's coming from every direction. In August 2024, India's Supreme Court brings an insolvency case back to life. Just a month later, a Delaware court confirms a default on a massive loan. Fast forward to June of the next year, and U.S. courts are okaying fire sales of its assets. And then, bam, the next month, India's highest court refuses to stop the clock. The walls were closing in, and fast. So how on earth did a company that set out to revolutionize education end up in this mess? To really get the crisis, we have to rewind, go right back to the beginning, to the story of one teacher's unbelievable rise to the top. It really did all start with one guy, Baiju Ravindran. He was an engineer who became this superstar tutor, famous for packing entire stadiums for his math classes. I mean, he was a legit rock star in the education world. In 2015, he decided to bottle that magic, launching BYJU'S, the learning app, to bring his classroom to millions. And the growth was, well, it was explosive. What started as just a digital app quickly transformed into this hybrid learning behemoth. They made huge acquisitions like Osmo, an educational gaming company, in 2019, S11, and then the massive test prep chain Akash in 2021, S14. This whole expansion was fueled by a fire hose of cash, including a massive $1.2 billion loan, S9, which then paid for their big pivot into physical tuition centers, S. I mean, just look at this chart. It shows the sheer scale of their ambition. We're talking over $2.4 billion spent on acquisitions in just a few years. S11, S12, S13, S14, and this wasn't random. They were buying up a piece of every single educational market out there. From Epic, a U.S. reading app for kids, to Great Learning, a platform for adults. The goal was crystal clear: dominate education globally in every single category. But this is where the story takes a sharp turn. See, that kind of rapid, debt-fueled growth feels great, but it demands incredibly tight financial discipline. And soon, the numbers started telling a very, very different story. Okay, let's break this down. From financial year 21 to 22, the revenue more than doubled. On the surface, that looks amazing, right? But then you look at the bottom line. The net losses also nearly doubled, ballooning to over 8,200 crore rupees. That's roughly $1 billion US. This raised a huge blinking red flag. Was any of this growth actually sustainable? And then came the very public signs of a full-blown crisis. Their auditor, Deloitte, resigned. That's a massive red flag in the corporate world. India's enforcement directorate started investigating potential foreign exchange violations. The default on that billion-dollar loan was officially confirmed. Investors started revolting, and the company was pushed into fire sales of those U.S. assets they were once so proud of. The whole thing was just unraveling in real time for everyone to see. So what went wrong with the strategy? To understand this, we can use a really useful framework called effectuation. Think of it like this. It's an entrepreneurial approach where you start with what you've got and you only risk what you can truly afford to lose. It's nimble, it's smart, it's opportunistic. And this slide just perfectly captures the huge shift they made. The early BYJU'S, that was pure effectuation. Ravindran's teaching talent, workshops they built from scratch, very limited risk. But then the company switched its entire playbook to a massive, high-leverage, $1.2 billion bet that needed absolutely everything to go right. The smart idea of affordable loss was totally thrown out the window for a giant gamble on scale. So just how fragile was this new strategy? To really get the economics of their big offline push, let's run a quick scenario analysis. And I have to be super clear here. These are illustrative assumptions we're using to test the model. These are not reported company figures. Okay, so based on these assumptions, Each student brings in about 27,000 rupees after you cover the immediate costs. But, and this is a huge but, with fixed costs of 1.8 crore rupees per center, you need to enroll almost 700 students just to break even. That is an incredibly high bar to clear for every single location. And this chart really shows you just how razor thin those margins are. If you fall just a little bit short, say 600 students, the center loses money. If you manage to beat the target with 800 students, it turns a nice profit. Profitability is insanely sensitive to hitting those high enrollment numbers, center by center, all across the country. That's a massive operational headache. This brings us to a second key question. Using another framework, what is BYJU'S 0 to 1 advantage? In simple terms, what's their unique edge? What's the one thing they do that is so hard for anyone else to copy? And here's the argument. The company's real defensible wedge may have shifted. It's probably not about the digital content anymore, which rivals could and did copy. The thinking is that its real, lasting value now lies in its physical network, the hybrid tuition centers, and critically, the proven results of the Akash test prep brand. Now, that is a moat that's a lot harder and a lot slower for competitors to build. So this all brings us to today. With all this legal and financial pressure coming down, the founder is facing a monumental decision, and the clock is ticking loudly. There are basically 4 paths forward from here. So the central question is this: what's the single most important move you make in the next 3 to 6 months to guarantee the company survives? And here's the catch. Every single choice comes with a painful trade-off. Here are the 4 options on the table. Path A is about leadership. You bring in a new CEO to get credibility back, but the founder has to give up control. Path B is about survival. You protect the crown jewel, Akash, and you sell off everything else for cash, but you have to abandon the dream of a global empire. Path C means you lean into the legal mess, use the courts to buy yourself some breathing room, but you lose your autonomy. And finally, Path D is a total reset. Go back to basics with a much smaller, focused company, but you sacrifice that massive scale you fought so hard to build. So, as we zoom out from this crisis, what are the big lessons here? For anyone who follows business, for any entrepreneur out there, what can we all learn from a titan that's been pushed right to the very brink? I think there are 3 really crucial takeaways here. First, that scrappy startup agility is great, but it has to grow up into disciplined governance, especially when you take on billions in debt. Second, your competitive advantage is never static. It moves. You have to constantly know where your real defensible moat is. And third, simple unit economics, like that break-even math we did, it's the ultimate truth serum. It cuts right through the hype and tells you if a strategy actually has a prayer of working. And that brings us to the final call. Let's put you in the hot seat. It's Monday morning. You have to advise BYJU Ravindran on his very next move. Which path do you tell him to take? A, B, C, or D? The entire future of a once unstoppable education empire is hanging in the balance.